What's up, guys? I hope you're doing well. One of the things that I've always kind of, uh, we'll say, has intrigued me, has been like the different forms of money, right? And so, like the whole like what is money argument, like both philosophically, like actual physically, whatever. And like how do we have these different forms, all in our case in the United States denominated in dollars, and then we're basically going to there's like different way how to describe it. I don't know. We call them monetary aggregates to where there's like different forms or whatever. And like in this case, we're going to be talking about base money, which is M naught or M0, whatever you want to call it. And then basically, which includes like money in circulation, bank reserves, like the most liquid forms of dollars, period. Then you can add stuff on top of it with like savings accounts, demand deposits, and then there's some money market stuff, and you can also at some point we lumped repos in there as well. Not those past three examples or whatever are not a part of M naught, or base money. Those are a part of like the higher forms, I guess, where you got like M1, M2, at one point M3, but the Fed stopped talking about it. But anyways, while I was researching this stuff and going into it and making the post, one of the things I realized was pretty interesting. And I'll show you a graph and I'll point it out when we get there. So I will start the screen share to the post that has that graph in it, which I thought was pretty cool. Because it really ties into one of the kind of fundamental questions I've been thinking about for in a different point of view, I guess. Anyways, so one of the things, and one way to easily point this out, is have you ever like wondered why you can't just like you don't have a debit card for your savings account, and like you have to like transfer money into your checking account or whatever before you can actually use your debit card? And that's kind of what we're talking about with this respect, is like it's, I guess a good way to describe it was like the different ways dollars are stored, right? Um, and so basically with base money, it's the most liquid form. Um, and it doesn't have to be like transformed into a different type before you can actually transact it. Like it's literally like part of its physical currency to where you can literally just hand to hand give it to one another. Um, and now the Fed in their graphs even states that this is a an approximation, right? Because to know, you can't really know exactly how many physical dollars there are, because I mean, unless they're, I don't think they're tracking every single dollar bill out there, period. At least like whether or not it's like someone may have ripped to shreds, or I mean, like you guys, if any of you have ever been like a cashier or like a waiter or anyone who's like deals with money, you've seen some of the condition of some of the bills that people have in physical currency. So it's an approximation. Um, but another part of this is the bank reserves, right? And so the way I think about it is bank reserves are essentially like checking deposits for commercial banks for like interbank. They're like interbank money, right? To where they can use it in between depository institutions of the Federal Reserve System, right? And so, like Wells Fargo can transfer bank reserves and stuff with, say, JP Morgan. Um, it's kind of the, it's not quite the same kind of structure of transaction, kind of behind the curtain, as if like two, I guess, like people transacted, or like whenever you buy something from a business, it's like that transaction doesn't happen in the same form, but it's kind of the same general idea, I guess. Anyways, other names, like I said, for base money is M naught or M0, and then also high powered money, because you have to remember bank reserves are a part of this. And so when we were in a fractional reserve system, um, it was literally multiplied, like the bank reserves were multiplied by whatever that reserve requirement was. So if it was 10%, they were multiplied by 10 because they could lend out 10 times as much because they only had to be backed by 10% with reserves. But anyway, here's the graph that really struck my, or like what really clicked when I was thinking through this, right? Is so this red line See if I can zoom in a little bit more for you guys, make it a little easier to see, make sure my head's not blocking it. Awesome. So this red line right here is the actual currency in circulation, and then the blue line is the reserve balances, right? And one thing that you can see immediately is like it looks like the reserve balances are zero until like 2008-ish, right? They're not. It's just because we have so much reserves now that the scaling is orders of magnitude larger. Like if I remember correctly, the amount of bank reserves we had in 2008 was around like 40 billion or 400 billion. I'm going to go with 40 billion because 400 billion would be somewhere in here. So probably 40 billion. And so that's literally like 100 times smaller than what it is now. And so we see it just go straight up for the most part. And this is like, when we started like quantitative easing and stuff like that, to where we started like the amount of bank reserves started to skyrocket relative to, I guess, pre-GFC. But what really got me thinking was especially right here with 2019, because one of the things I've brought up a few times, and I've heard a lot of people in the space talk about, is the whole repo spike that happened in 2019, the end of 2019, which is right here. And basically, um, in one of the Federal Reserve, I think it was the New York Fed, one of their staff reports, they attributed that kind of repo spike to there not being enough reserves in the system, right? And basically, the idea was that they had we are currently in like what they call an ample reserves regime, which is basically saying there's an ample amount of reserves, which they define as having enough that any significant fluctuation in the amount of bank reserves in the system will not have an effect on short-term interest rates, right? That's kind of how they're defining it. And in my post on the ample reserves regime and stuff like that, I linked the staff report and everything else with that stuff in it. So if you want to read more on that, you can, wherever I put the link in here in the post, if you can find it. But yeah. Anyways, what I thought was funny, or what got me thinking, was so basically the argument was in 2019 was that that repo spike happened because there was no longer an ample amount of reserves. Well, we also happen to see that this was the exact time that the amount of reserves in the system, the reserve balances, dropped below the amount of currency in circulation for the first time since 2008, 2009-ish here, right? And so you see here, we'll say this is probably, I don't know, I guess you could zoom in when actually going to the chart. I just wanted I didn't realize this until after I kind of like structured the whole post. So this might get more research in a post in and of itself. And I'll zoom in on here for exact dates and stuff like that, but like probably like 2018 whatever to 2019 or so, when this actually started to happen. And then we had the repo spikes, and then everything in 2020 happened, and the amount of bank reserves just literally went straight up for a minute, and it's basically just been doing the same thing until they're starting to level off now with everything that's been going on, the Fed raising the Fed funds and QE tapering and stuff like that. Actually, QE coming to a halt last time I checked. But anyways, that's one of the things that I was thinking about, was like how I'm not 100% sure on what kind of dynamic that would cause that for because I don't really see how the amount of reserves on the reserve accounts of commercial banks and other maybe actually, now that I think about it, and other people, like other participants in the repo market, would affect the currency in circulation, right? But you also have to think about how in repo, it's not just commercial banks and stuff that are in there. You also have hedge funds, money market funds, and other institutions that are not depository institutions at the Fed. So they do not have bank reserves. And that's actually one of the reasons why the Federal Reserve has the overnight repo rate, or the overnight reverse repo rate, is to basically have that kind of back end funding, to where they can kind of hold sway in that market for institutions that do not have reserve accounts. Because with like commercial banks, they have reserve accounts, so the can just use interest on reserve balances, right, to create that incentive. Whereas if you're talking about some other depository, or not, sorry, misspoke, some other institution that does not have bank reserves, then um, interest on reserve balances won't have any effect on them. And so the Fed uses the reverse repo for the reverse repo facility for that purpose, to kind of create that incentive for those institutions. So I guess that's one way the currency in circulation could actually like have an influence on that. So maybe it wasn't necessarily, maybe the spike in repo rates wasn't specific to just commercial banks, which I guess, which was my initial thought, because I wasn't separating the different entities in my mind at the time. And now that I'm kind of talking it through and everything, it's starting to kind of, you really have to get into that nuance to understand it, I think. And so maybe that's where that liquidity problems were, was because, well, maybe no. I don't know. I have to think about it more. But you guys got a little bit of a me thinking out loud for a couple minutes. But that's like this area right here, I think was really interesting. It may be completely coincidence, and I'm looking way too much into it. But it's just something I thought that the timing was too perfect, so to speak, for me to really just like not do anything or not say anything about it or think about it at least. But anyways, it's definitely something to look into. Um, yeah. So why is base money important? Um, so again, this is what the banks would use to do, I guess from both respects with reserves. Not base money doesn't have much of an effect from the reserve side of things anymore, because there's the reserve requirement 0%. So um, banks don't need reserves anymore, and they have a lot of them, which we've talked about the past few minutes. Um, but the currency in circulation part is different. But yeah, try not to get ahead of myself and keep it structured so I don't just run off on tangents on you guys. Anyways, so basically, the Fed has said, in the past at least, that the measures of money supply had shown a close relationship to other economic variables, including GDP. Um, and then Milton Friedman, his saying with inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than output. Okay. So basically, more money chasing fewer goods and services, or the same amount of goods and services, induces inflation. And kind of the caveat he puts at the second half of the sentence is basically, if productivity and the amount, meaning the amount of goods and services, increases at the same rate or proportional to the money supply, then you're fine. Otherwise, no. And here's kind of just a graph of the monetary base in general. If you notice, this is a superposition of the two. And so it's kind of a little bit more stretched out and sloping. You can tell also by the scaling how it's much larger. But yeah, so again, basically, it's mostly the bank reserves part. In terms of why it changes is, I mean, we know that the Federal Reserve changes the amount of bank reserves to implement monetary policy, right? And so that's kind of one like reason why it changes, and then you have the actual physical currency side of it as well. And here's where we get to the kind of different types of broad money. I guess I can zoom out since we're not trying to read a chart anymore. Um, but you have base money and broad money, right? Where base money is what we've been talking about with M naught, that high powered money with the bank reserves and the currency in circulation and such. Then you have broad money, which is basically talking about the different types, right? And so, like, we have M1, where we kind of add a few more types of things in there, and this will include demand deposits and other checkable deposits. Um, Basically showing like just it has all of M naught and demand deposits and checking deposits and everything. Um, and then you have M2, which is what most people talk about and what's considered the money supply, which includes like savings, time deposits, and like retail money market securities, right? So when you put money in a money market fund, just you, relative to the kind of the big institutional players, it's not going to be very much. I mean, you're not holding billions of dollars in a money market fund. Um, Most likely, I guess. Who knows? Um, but there's also and this is what's considered the money supply, is what we normally talk about with M2. Um, it's typically what people mean when they talk about that. We used to have like, or this is where it kind of differs and gets a lot more nuanced, is with M3 and M4, which really depends on on which country you're talking about, and where they kind of change definitions and depending on how far they go and so on. Um, like we used to have an M3 in the United States, but the Fed stopped publishing the data on that, which basically just included like institutional money market funds, short-term repos, and other large liquid assets. So it's like we're talking about like the institutional money that was in kind of cash and cash equivalents, I guess you could say, like short-term repos, to where I mean, on my repo post, I talked a bit about, I don't remember the exact percentage off the top of my head, but something of like 80%, 80 to 90% of tri-party repos are overnight, somewhere in that ballpark, the vast majority of those. And tri-party repos are the majority of the repo market. Not all of them with the with one of the counterparties as as the Fed. Um, but yeah, but that's no longer published, which is a shame. But anyways, that's all for the actual post part. But anyways, yeah, pretty much just base money, learning the different types, learning kind of the nuances between how the things are measured. Because with the Federal Reserve and all the monetary stuff, and I guess just you know what? I don't even want to say just like economic stuff in general. It's really like any type of science or pseudoscience, whatever you want to call it. Um, you have to read the footnotes because it changes. Um, because people like with the CPI, people will just be like, "Oh, yeah, it's inflation, period." But they don't look at like the different weightings, how they're measuring the different aspects and stuff like that, like housing, where it's not really housing prices. They have stuff like owner's equivalent rent, and then various other things. Um, but yeah, that's all I got for this one. So I hope you guys have a good day, and I will see you on the next one.